Hi there. Planning to transfer shares to your spouse before selling a business? Learn how capital gains tax rules could affect your overall tax outcome.
A business owner who is contemplating a multi-million-pound exit is highly motivated to optimize their overall tax position. A common strategy shared among founders is to transfer 50% of the company's shares to a spouse just weeks before the buyout completes. The math seems logical. The intention is to double the £1 million business asset disposal relief limit and utilize 2 annual capital gains tax exemptions. But executing this paper transfer right at the finish line often triggers a 24% higher rate capital gains tax penalty instead of saving money. Navigating the intersection of corporate exits and UK tax law requires the specialized expertise of pro-tax accountant. To understand why this fails, we will dissect Section 58, the rigid Battiar timeline rules, and HMRC's devastating anti-avoidance traps. Statutory mechanisms allow tax-free transfers between spouses, but ignoring the strict legal timing creates a significant financial liability. Under Section 58 of the Taxation of Chargeable Gains Act, 1992, transfers of assets between spouses living together are structurally neutral for CGT purposes. The actual consideration paid is ignored. Instead, the receiving spouse inherits the original cost basis of the asset. This statutory mechanism creates a deferral of the gain, not a complete exemption. The tax still comes due upon the final sale to a third party. The disconnect occurs here. Founders assume this deferral automatically transfers their specialized tax relief eligibility to their spouse. Many companies only discover this technicality months before a sale, long after the statutory window to fix the error has closed. Moving an asset between spouses successfully transfers ownership, but it does not automatically transfer the specific tax reliefs earned by the original owner's history. To qualify for Business Asset Disposal Relief, or BADR, the individual selling the shares must meet strict independent requirements. First, the receiving spouse must hold at least 5% of the ordinary share capital and voting rights. Second, the spouse must be an active employee or officer of the company for 24 full months prior to the date of disposal. This split-screen ledger models a hypothetical £2 million corporate sale in the 2026-27 tax year to compare sole ownership versus a last-minute transfer. Under sole ownership, the original founder's first £1 million qualifies for BADR at the 18% rate, creating a £180,000 liability. The remaining $1 million is taxed at the 24% higher rate. The total family tax bill is roughly £419,000. Shifting to the right side of the ledger, we analyze the last-minute transfer scenario where 50% was gifted just weeks before the sale completes. The receiving spouse instantly fails the 24-month employment and ownership test. The spouse's entire £1 million portion is taxed at 24%, yielding virtually zero overall tax savings for the family unit. Failing to respect the 2-year BADR test renders a complex legal maneuver a pointless exercise that only saves a nominal £3,000 annual exemption. The execution of these transfers is also governed by specific anti-avoidance laws, starting with the strict timeline rules of Section 28 of the TCJA. For capital gains purposes, the exact date of disposal is triggered when an unconditional contract is signed, not when the physical shares complete. Any spousal share transfer executed after this unconditional contract date is legally void for tax purposes. Even transfers executed before the contract is signed face the Ramsey principle, known by tax professionals as the step transaction doctrine. This strict doctrine gives HMRC the legal authority to fully audit and outright reject these artificial spousal transfers. Under Ramsey, if a transfer contains artificial steps with no commercial purpose other than tax avoidance, HMRC can legally ignore them. If a corporate buyout is guaranteed, HMRC treats a last-minute spouse transfer as a sham and taxes the original owner on 100% of the gain. Attempting to slip a spouse onto the cap table when a deal is already commercially agreed will simply trigger anti-avoidance laws and nullify the transfer. Beyond the timing, the actual nature of the shares themselves must satisfy the settlements legislation. The legal boundaries of interspousal gifts are dictated by the landmark Arctic Systems precedent. To survive an HMRC challenge, the gift to the spouse must be completely outright and unconditional. The transferred shares must be ordinary shares, carrying the exact same full rights to capital and voting as the founder shares. Using restricted preference shares designed solely to siphon income without transferring genuine economic risk will result in a denied exemption. Flawless corporate administration is required. A J30 stock transfer form must be completed with nil in the consideration money box to formalize an outright gift. The mandatory corporate follow-through requires updating the Companies House Register of Members and holding formal board meetings to approve the transfer. A transfer is only legitimate if it shifts real economic power and is documented with the exact same rigor as an arm's-length transaction with a third party. A successful exit scenario relies on a share transfer planned and legally executed more than 2 full years before a corporate exit. Returning to the financial model, the 2-year planned transfer results in 2 separate £1 million allocations, taxing both spouses at the 18% Bay ADR rate. This outcome relies on 3 golden rules: a 2-year minimum timeline, active employee or officer status, and genuine commercial reality. Proactive interspousal transfers also heavily impact property landlords and dividend-drawing contractors managing their exposure. This video is for educational purposes, based on projected 2026-27 UK rules, and is not formal financial advice. Securing these benefits requires expert intervention long before buyers start auditing your corporate history. If you are navigating a business sale or exit planning, contact Pro Tax Accountant for bespoke strategic advice. Reach out using the phone number, email, or website on screen, and subscribe to our channel for more technical tax breakdowns. Tax efficiency in a multi-million-pound exit requires years of deliberate, perfectly documented foresight.